Our April inflation report showed us that inflation came in cooler than expected. At the same time, we also saw that home prices surprisingly started to grow, and at the same time, we've also been seeing oil prices start to grow pretty significantly. The reason why these three things matter, especially in terms of the housing market, is because, for one, when you see inflation come in cooler than expected, that gives the Federal Reserve Bank less ammunition to continue raising interest rates. But when you see home prices come in hotter than expected, that gives the Federal Reserve Bank more ammunition to raise interest rates because, well, like we were talking about in previous videos, in the CPI number, the inflation number, a third of the inflation is housing market affiliated. It's the shelter numbers, it's the owner's equivalent rent. So a third of our inflation number comes from the housing market. And now when we're seeing mortgage rates start to drop a little bit and home prices are starting to rise, you can bet that that's going to affect the inflation numbers in the coming months, which could give the Federal Reserve Bank more fuel to raise interest rates, especially later this year in 2023. And then third, we have the craziness happening in the oil market. And the reason why we're seeing this craziness in the oil market is because OPEC, these countries around the world that control the oil supply, unexpectedly came out and said that they're going to cut the supply of oil. When you cut the supply of oil without reducing the demand, it causes the price of oil to go up, which impacts things like gas prices and other energy prices. And the reason why that's significant when it comes to, well, the housing market is because when oil prices rise, the price of everything goes up. Because now when you want to get your groceries from the manufacturer to Walmart, or from the warehouse to the Amazon store to you got to pay for energy or gas to get the product from one place to the other. So higher oil prices cause the price of everything to rise. And the reason why that's significant is because when the prices of things are rising, that pushes inflation higher, which then could force the Federal Reserve Bank to take even more aggressive action to bring down inflation. So in the most recent report that we got, it said that inflation was cooler than expected. But now if you start to forecast what's going to happen next month and the month after that, if we continue to see mortgage rates at this kind of little slump, that's good news for somebody who wants to buy a home because now you can get a lower interest rate to go out and buy a home. But that could put more gas onto the Federal Reserve Bank to raise interest rates more aggressively. And if oil prices stay high, that again would put more fuel on the Federal Reserve Bank to raise interest rates more aggressively, which both impact the housing market. The second reason why this is so important to understand has again to do with the Federal Reserve Bank, but not because of interest rates. Instead, it's because of what the Federal Reserve Bank says might be coming later this year. So when the latest inflation report came out, we also got some other information from the Federal Reserve Bank directly, where they said that they are now predicting a recession by the end of 2023. Now, to just kind of clear the air, technically, by definition, we are not in a recession right now. That is the definition, because it's not been declared. However, the average American is already in a recession. So whether or not we're in a recession, I guess, is just a matter of semantics. The average American is already in a recession right now. But now we're having the Federal Reserve Bank saying that we are going to enter a technical recession by the end of the year, a recession by definition. Now, the reason why that's important to understand is because now we have to go back to the housing market. What impacts the price of a home? It's supply and demand. And one of the factors that impacts demand is mortgage rates. When you have higher mortgage rates, you have less demand. If mortgage rates jumped up to 10% or 12% tomorrow, you bet that there's going to be a lot less people going out to buy a home because that's going to make buying a home much less affordable. But the second aspect of the demand side of homes is the economy. Because when people are making less salaries, if people don't have a job, or if people don't feel like they're going to see the same upside in their company, they're going to be less likely to go out and buy a home because people want to go out and make big purchases when they feel like they're rich. When you feel like everything is going good, your stocks are rising, you're getting a promotion, you're getting bonuses, you're getting raises, people feel much more comfortable to buy a home. But when you're not seeing that, when you're seeing an economic slowdown, well, then that also reduces the demand. And so what we're seeing is that we're seeing more and more institutions, now the Federal Reserve Bank as well, who are saying that we're going to see more economic pain coming in 2023 and into 2024. Like what we've been saying here is that this economic craziness that we're going to see is not a 2023 thing. This is going to be a multi-year process, and it's going to take time because there's still a lot of excess cash in our economy. We have never seen this much money enter our economy that we've seen over the last few years, and it's going to take time for this money to disperse. But once that money gets dispersed, that's when we're going to really start to see more of the economic pain. Yeah, the average person has already started to feel economic pain because of the high inflation, but we haven't felt the real extent of the high inflation, and we haven't felt the real extent of the higher interest rates combined. We started to see a little glimpse of it when we saw a couple banks here in the United States collapse, like when Silicon Valley Bank collapsed, when Signature Bank collapsed. That was the start, but that also was protected because then we had the Federal Reserve Bank, along with FDIC, along with the Treasury Secretary, Janet Yellen, come together to essentially protect all depositors, although the investors and the owners of these banks lost a lot of money. The depositors, which were safe, and that protected against a real mass panic and contagion in the banking sector. But this is we're now understanding higher interest rates are going to cause more economic pain. I've been talking about the debt crisis that we have going on because we have the highest amount of national debt, the highest amount of corporate debt, and the highest amount of household debt ever. And over the next 24 months, we're going to see a huge chunk of this debt readjust. Why? Because most corporate debt and most national debt, in fact, nearly all of this debt is not a 30-year fixed rate mortgage. Most of this debt readjusts every year, 2 years, or 5 years, or sometimes 10 years. And we're going to see a huge chunk. I think it's about half of this debt, especially the corporate debt, is going to readjust in the next 24 months. So now as the interest rate on this debt starts to readjust over the course of the next 24 months, that means the expenses that these companies and our government will have to pay are going to shoot up. And if the expenses rise for a company, but the revenue doesn't rise enough to meet the higher expenses, the company's going to have to make adjustments. They're going to have to cut their costs. Because if your costs are rising when your revenues are not, you're going to need to do something to maintain profitability. And that would mean more layoffs. And this, we're understanding all these different factors is so crucial as a financially savvy investor, because for the first time in the history of time, we have this publicly available information. Things like YouTube, things like podcasts have made financial education and financial news more accessible than ever before, because prior to this, you only got what you saw on the Wall Street Journal or CNBC. And so now you have people, regular people, who have access to financial education and financial news. And so this is where things become very interesting, because the reality is there's a lot of red flags out there. And the most important thing for you to do is not to panic, it's just to be prepared. And being prepared means now understanding that, hey, there's red flags. Maybe nothing will happen, okay? Maybe everything will just blow over. But in case something bad does happen economically, how can you protect yourself? And the way that you can do that is by now living below your means. 2023 is not the year for you to go out and finance a new truck. 2023 is the year for you to get financially prepared and financially sound, period. So take the income that you have right now, live below your means, pay down your credit card debt, get out of this financial hole that you're in, and then use the remainder income to build up a savings cushion so you have an emergency fund, and put aside some cash to take advantage of investment opportunities, and set up an investment system. Maybe you set up a passive investing system where you're doing something like dollar cost averaging your money into the stock market at the very least. If you want to get even more involved, well, then you can learn about how to invest your money. Now, if this is all kind of a foreign language to you, I have a free ebook that will walk you through how to start investing, how you can start generating cash flow, how you can start making your first investment, whether it's into the stock market or real estate market. It's a free ebook that you can read through Market Insiders. If you want to read this ebook on how you can start investing and start generating cash flow, I will link that ebook for you down in the description below. But this is where you have to start getting educated and aware of what's happening around you. That way you can take the best care of yourself and your family. Because the reality is, no institution, no government, no central bank is going to want to say that we have pain coming ahead. Because if anybody said that, what would happen? People would panic. They would freak out. When you saw the worries about the banking sector, people panicked. Everybody went to their local bank, pulled their money out. Some people put it under their mattress. Some people moved it to bigger banks. Some people used it to buy gold. People panicked. And this is where you have to understand that nobody wants to create panic, and you have a lot of people behind the scenes that are trying to protect us against major economic pain. But what you want to do is just understand, look, the range of opportunities and possibilities is number one, we don't have anything bad happen. Number two, on this end is we have major economic pain. Where will we be? Who knows? But this is, we're now understanding this range of opportunities and possibilities and then saying, okay, if this is the range of options, I want to make sure I'm prepared for this and this. Most people live a life thinking, I don't think anything bad is going to happen, so I'm never going to prepare. And then when something bad happens, because the reality is recessions happen, they have happened about every decade forever now. It's a fact. That's why you see market crashes happen again and again and again. They happen every decade, and they still seem to blindside people. Understand that this does happen. Economic pain happens. But now, are you going to be prepared for it or not? That's why people who have an emergency fund can protect themselves from going into debt, because the reality is life happens. Emergency funds are not just there for theory. It's because people break their arms. It's because windows break. It's because furnaces break. It's because cars break down. And when this happens, when life happens, you need money to be able to pay this cost, because if you don't have the money, then you're going to have to go into debt to fix the problem, and then you have to go into a financial hole to then fix the problem. And now you have another problem to deal with. And so now, for you, this is where you want to understand, okay, there's a chance that we can have more financial pain coming. How do you protect yourself? How do you learn? How do you start investing? Then when it comes to the housing market, don't chase things. And this goes to every asset class, not just the housing market. If you want to buy a home or a rental property, fine. Make sure you can afford it. If it's a rental property, the analysis is completely different. When I invest in a rental property, I don't invest in a property based off of how much I think it's going to be worth in the future. I invest in a property based off of how much cash flow this property will generate for me. And if a property is going to generate me enough cash flow, well, that means I also have a buffer that if I had to reduce rents or if we have some vacancies, I'm still going to be okay. Now, you might say, but Jaspreet, where are you finding these types of deals? Yeah, you're going to have to be much pickier, because the reality is we have less inventory right now. Less inventory means you're going to have to be more picky. You're going to have to put in more work. It doesn't mean that you should never buy anything or should just completely sit on the sidelines. But understand and be pickier with your investments, because we have a lot of strange things happening right now. We still have high inflation. High inflation is making things more expensive and is continuing to cause pain in the economy. This is a fact. You cannot debate that, because that is the reality of what's happening. We have high inflation. High inflation is slowing down the economy because it is reducing people's ability to spend, because people have to spend more money on necessary items. They have less money to spend on discretionary items. Fact. Second fact is, in order to bring down inflation, the Federal Reserve Bank is being forced to raise interest rates. Higher interest rates are also hurting the economy. Fact. The higher interest rates are making borrowing more expensive, which decreases spending. Fact. Higher interest rates are making past debts more expensive. Facts, which is increasing expenses for people through things like credit cards, because your credit card debt is not a fixed rate debt, it's a variable interest rate debt. So when interest rates go up, your credit card debt goes up. When interest rates go up, corporate debt goes up. When interest rates go up, servicing costs also go up. Now, what I want to remind you here is that market crashes and recessions create more millionaires than any other time, because that also means that assets go on sale. And most of the time when things go on sale, you see people freaking out because they're ready to buy. When Macy's has a sale on sweaters, you see a line around the block of people trying to buy that Macy's sweater. But when assets go on sale, like when you see the stock market crash, people panic, they sell, and they don't want to touch stocks. When you see a crash or pain in the real estate market, people sell, they panic, they run away, and they don't want to buy real estate. Now, this is where, if you're prepared, you will have the ability to then be able to capitalize on distressed assets if they come your way. But being prepared means, number one, you got to have access to money, because if you see a great investment opportunity but you have no money, you can't buy it. And second, you got to be educated, because you got to be able to actually find the opportunity. You got to know where to look. You got to know how to analyze the opportunity. We cover that in the Market Insiders ebook, but this is where now you have to start investing in your own education, start spending time to build your own education, and then also start researching. And then you also got to start putting the money aside that we have the ability to capitalize on opportunities, because there's a lot of emotion out there. And most traditional media is only in the business of selling emotion. And this is where I want you to start building that financial education. That way you understand, okay, let's look at this practically. Market crashes happen. They have happened in the past and they will continue to happen. We have a lot of red flags in our economy right now. So what can I do? I can be prepared. I can be financially educated. That way I can capitalize on whatever opportunities that come my way. And even if nothing bad happens, well, I just have a big bank account and then I can go to Disney World. So this is where it pays to be financially educated. That way, if something bad does happen, you don't get smacked by it and you can capitalize on it. But it starts with you understanding what's going on. In 2023, when France announced that they wanted to raise the retirement age when you can start collecting government benefits from 62 to 64, people rioted. They protested, but the bill continued through the government. Also in 2023, Argentina passed a law making it easier for their citizens to fund their retirement by getting